Good morning, gentlemen. Welcome, everyone, to this great panel we have this morning. It is truly amazing how much the world as a whole, and even our multifamily lending and investment market has changed in 2022. Picture this. The 10-year Treasury at 1.51. 1 month LIBOR is 10 basis points. Multifamily loans are being written at 3% coupons for 10 years. Apartment sales in the last quarter alone reached $160 billion, the most ever. Russia is making some weird-looking troop movements, not a war with Ukraine. Gentlemen, ladies and gentlemen, that was our world as we drove to work Monday morning, January 3rd, 2022, only 10 months ago. While our world has changed dramatically, I find that I have a very different mindset than many people. I believe two things. First, I'm an optimist. That's my nature. And I believe that every challenge is coupled with tremendous opportunities. Our business at Meridian continues to execute on the once-in-a-lifetime opportunity we have in front of us every single day to advise our clients in a market environment that has never been seen before, to obtain new loans, new clients, and new relationships and guidance. And second, I am mindful of cycles come and go. I truly have to say at this point, I'm largely unfazed by the ups and downs of our market. The ups are always great, and the downs are always seem worse than they are. I'm actually in business for almost 39 years, so I've gone through many cycles. And I would just like to say this, it's easy to do well and look great in an up market, but the true test of excellence is resiliency. Can you survive and even thrive over a long period of time? Internally at Meridian, I always say that a great general is only considered a great general if there's actually a war. We're not in a war, we're not on a battlefield, but we're in something, and we'll try by the end of this panel today to really try to give everyone here some real insight and really some guidance, because many of you have never seen, a cycle as we're starting to enter. We have an amazing group of panelists this morning that truly need no introduction. But I'll ask them to go down the line and introduce themselves anyway. And then we will get into some very interesting topics we have prepared. David, I'd like to start with you, but I know that you can never introduce yourself as well as I can. David is the CEO of NewPoint, which is a partnership with Meridian in the Fannie Freddie business, but his real claim to fame, he was the CEO of Freddie Mac, and would say one of the most prolific multifamily lenders in the country, and has some tremendous insight. So David, I'll let you introduce yourself.
Well, I think you just did, but thank you, Ralph.
There's a lot more to say about yourself.
I like how you framed the discussion this morning. I look forward to jumping in, but as Ralph mentioned, CEO of NewPoint Real Estate Capital, we think the fastest growing finance company in the commercial real estate lending space today, sponsored by Meridian Capital, and also have the privilege of serving as executive chairman at Meridian Capital.
Thank you. Doug?
Doug Tiesi. I'm the CEO and founder of Argentic Investment Management. We're a middle markets, floating rate and fixed rate commercial loan lender. We've been around for 9 years. We currently carry a book of $5 billion of floating rate loans, and we control $18 billion of fixed rate loans through CMBS B pieces.
Doug is also a dear friend, very good, efficient lender. And actually, just the week before COVID, I called Doug on a deal that was teetering, and I said, Doug, this is an existing, very strong relationship, and we closed the loan, and thank God, I think it's doing pretty well.
You still owe me on that one.
Sure. Peter?
Peter Smith, TPG Real Estate Finance. I'm Chief Investment Officer, mid-market lender, exactly, generally transitional space. Multifamily has been our big focus for the last few years, and our book is around $5.5 billion right now of all floating rate, a couple of mezzanine positions, which will probably grow next year.
We know Peter a long time through different, as his career has grown, also just a great lender, real mensch, and someone that, Meridian, we always say that, very reliable. Ryan.
Morning, guys. Brian Sedrish. I am part of Related Fund Management, which is the third-party institutional fund management business for Related. I've been here, or Related, for 10 years. I run their credit business, so we are currently investing out of a $1 billion credit fund, and that's really preferred equity, mezzanine, relatively asset class agnostic. Multifamily, obviously, being one that's certainly a focus of ours.
Thank you, Brian. And anyone that knows Related, I mean, your company has done the most amazing job in building Hudson Yards, but on a personal level, they own Equinox and Soul Cycles. So when I can't get into a class, I say I know the owner of Related, and they say, what does Related have to do with us? But it works sometimes. But anyway, so as we sit here this morning, and we're all saying to ourselves, okay, what is Ralph Herzka going to teach me that I don't know? So the first thing is, I'm not here to teach anything. I'm here just to share some questions, make it very interactive, and really hear from my colleagues here how they're viewing the current market, some advice. So the first topic, multifamily loan volume, the roles of the agencies and the overall lender appetite. I just want to say this. We've heard $5 billion, $5 billion, $5 billion. God willing, Meridian will hit $60 billion this year. So you're all a big part of our success, and I want to thank you all personally for that. Thank God for the first 3 quarters, because that made it a great year. But that's what's good about a year. Someone asked me, how's your year? I said, I've had the best year ever. He said, really? I said, yeah. Rosh Hashanah was unbelievable. So, but we'll continue to balance through that. So we all know that we all get the cost of capital, values, and much more. But first, let's talk about liquidity. The MBA predicts that even with all the volatility this year, the multifamily lending market will be between $450 to $500 billion. Guys, let's just think about those numbers. I would love, I'm sure if I asked the eCore guys, they'd say 425 is in this conference. It's not, but whatever it is, a lot of it is in this conference. So I'd like to start with you, David. The agencies will lend in excess of $120 billion this year. Again, we know that the year was skewed. While there's been a lot of noise about banks and pulling back, the agencies have a mission. It's affordable housing. I think they've done you, as CEO of Freddie Mac, did an amazing job. And you, as CEO of NewPoint, is, like you said, the fastest growing. Share with us your view on liquidity, multifamily. And
Sure. And I actually think that probably the agencies will end even closer to $140 billion this year. I know been particularly active just as they're living up to their mission to provide liquidity, stability, and affordability, particularly liquidity and stability right now to the market. And so I know very active. They've yet to announce, the FHFA, their regulator and conservator, has yet to announce what their caps are for next year. So it's not certain, but there's a high likelihood they will be very similar to where they are this year, unlikely to be any higher, possibly just a smidge lower, but probably puts them at roughly the same volume next year. And so to your point, Ralph, in terms of overall volumes next year, the agencies are likely to be pretty constant. I think you probably will see a little bit more of retrenchment by some of the other capital sources. And in particular, I think it almost comes to the seasonality. You said the first 3 quarters of this year were really good. I think the converse happens next year, which is, unfortunately, I think things are really a little bit slow in the first quarter, as I think everyone continues to try to figure out kind of what makes sense, where rates are going, what's the Fed going to do, and then I think we come on strong sort of second through fourth quarter. And so I think we may be down in aggregate a little bit more next year. I think the banks pulling back a little bit. They certainly were incredibly active in the latter half of this year, agencies being constant. And I think at some point when the capital markets get their footing again, we'll see increased activity from those who are capital markets driven, the CMBS, CLO, the debt funds. So I think we'll have a good year next year. I think most capital sources will be kind of comparable, if again, some down a little bit, but it probably more is just it takes a little while for everyone to get kind of clarity as we continue to deal a little bit with some degree of uncertainty as to exactly where the economy is going, where the Fed's going, where prices are going to shake out.
Thank you. Peter, let me ask you a question. What is your specific perspective on leverage cutoff points, and what do you think smart for a lender to get paid. You have the ability to, part of a very large company, you see things from a very interesting perspective. What do you think volumes are? What do you think, first of all, give us a little bit of what your year looked like. You said $5 billion, but is that all heavily weighted in the first 3 quarters? And where do you sit now? What are you looking at as a semi-bridge lender, balance sheet lender?
Yeah,
If you can share that with us.
obviously things have tapered off a little bit, and things started getting wobbly in at the end of 2021 and early 2022. So we actually weren't super active in the first two quarters, and we ramped it up a little bit in the third quarter. So we could go in at a lower leverage point and charge a little bit more. Volume going forward, we have a lot of liquidity. I think probably have something like, and on the public REIT side, we have probably $600 million of dry powder to do deals, and we want to do additional stuff, and that includes equity as well as availability under CLOs. But volume was fine this year. A lot of multifamily seems to work. I think with respect to volume going for next year, I think it's going to be second half weighted, and because it really depends on how quickly, how do people repair when rate caps are burning off and whatnot, and how do you really sort of get into the next level when your rate cap, you did a deal at the beginning of, say 21 or something like that, your rate cap's burned off, and now they've done a great job, executed their business plan, looking at a deal right now in California, executed the business plan, going great. They bought it at bad market buy at 3% cap rate, but they've gotten it up to about 5% and doing great, but that doesn't cover the refinance debt costs. They got a cap that's burning off. So the real question is there's a lot of capital being formed to address that space, but how quickly do these people say, you know what, I can't get that done, and they move off and then cap rates move out. But I'm not really sure. It's going to be second half loaded. I'm not sure where the volume is going to be.
So Doug, why don't you share with us? You also have a different perspective.
Yeah,
because you're also a CMBS issuer. So
Yeah.
why don't you share that with us?
It's an interesting environment. One of the things that's happening in the background that's worth talking about is the money center banks are gone, right? They've sort of left the market right now because of Fed action, because of capital constraints, pressure from the regulators. Your regional banks have stepped in, but they're starting to get pretty full. So they're starting to push these loans down into the debt funds, which is an interesting dynamic because we were probably, Peter and I, we're comparable businesses in the sense we were probably looking at stabilized LTVs of around 70 to 75%, let's say, back in January. Now today, right, we're penciling out to 60 or 65% LTV. And the money center banks are gone. Life insurance companies have backed off to the 45s and 50% ranges. So we're actually seeing an inflow of sponsors that we typically don't deal with and larger transactions than we've dealt with in the past. And I think it's an interesting dynamic because what it means for debt funds like us is that we're getting a deluge of requests for multifamily loans from a whole different spectrum than what we've seen previously. So last year we did about $1.5 billion of multifamily loans, average size, let's call it 20 million, 25 million. So probably interesting to a lot of people in the room. This year will probably be closer to 30, 32 million. Again, similar size, but slowed down in the fourth quarter. And I think next year, I would imagine we'll do another 1.5 billion. But I bet our average loan size is probably closer to 40 or even 45 million at this point.
Thank you. Brian, why don't you share with us your perspective of, you play in so many areas. You're big owners of real estate. You play in the equity, the mezz, the senior and everything. So share with us some of your...
Yeah, sure. I'll talk a bit about our business in particular, which again is providing transitional capital, in this case for multifamily, although we span multiple different asset classes. And to be honest, this time is the time it starts getting fun for us. We have historically gotten priced out of most of the stuff with our cost of capital to participate in multifamily transactions because, as we know, the multifamily market is just so tight from a return perspective. So it's been very active for us recently. A lot of the deals, back to some of what the panelists said, you're finding that a lot of the senior lenders now are pushing down the cap or up the capital stack, less leverage, if you will. And so there's really a thicker tranche that we're coming in and providing that capital to bridge a sponsor who may have a maturity, may have a CapEx plan and they need capital. Our capital is typically 2-3 year type capital, and we're providing that bridge. And so historically, we might have been going from 70 to 85% of the cap, 90% of the cap stack, and now we're attaching at maybe 50%. We had a situation, we're doing a couple large multifamily deals right now. We had a situation where ultimately the senior lender pushed down to the tune of $20 million, pushed down the capital stack, because at the end of the day, when they're underwriting stabilized DSCRs, it doesn't work for them and they need to satisfy their credit committee. So we stepped up with that, plus the incremental capital to give them the leverage. And so we've been seeing just a ton of flow right now. Historically, our book has not been geared toward a lot of multi, and now I'd say half our book is pushing towards multi, if not more. So it's been interesting times.
So just to go a little bit off script, because it was mentioned here that the large banks have pulled back, the regional banks have stepped in. It's really interesting because at Meridian, because of the size that we are, we do a lot of business with so many different lenders. And we're not seeing, we are definitely seeing where a bank will say, this is a new customer, we're keeping our powder dry for existing clients. But we're seeing a fair amount of bank activity at all levels. But no question, the banks are definitely more cautious than some of the debt funds. Many years ago, I had a loan, I had several weeks where loans went to committee and they were getting turned down. Finally, I called the bank, I said, what do you do before committee? And they said, that's when we talk about, this is one of the other cycles, that's when we talk about the problem loans we have. I said, that's great. That's like having surgery from a surgeon that the patient just lost a patient. I wouldn't want to be that next patient after he just lost a patient. And the reality of it is, and this is not a question that we spoke about in the call, but just sitting here and thinking, we rehearsed and we made sure that we give everyone a true view without being too pessimistic, without being too optimistic. So if we're doing good, guys, then we did our job. If we're spooking you and getting you really nervous, we're doing our job. If we're giving you really optimism, we're doing our job. So we're here to really demonstrate to everyone that there's some good opportunities in this marketplace. But I'd love to hear your view. Someone said to me yesterday that banks are losing deposits, and no one here is really a bank. So maybe it's not the right forum for this, but because so many people in the room borrow from banks, and so many, and even every one of you, and it really ties into the next question, so I'll just blend it together. The theme of liquidity and where loans coming from. Over the past 2 years, it was the fastest growing segment of multifamily lending business has been the floating rate bridge segment, right? And the panel knows the market better than most of you. You all were in that market in every single area in the capital stack. Most of these loans were funded through warehouse lines, CLOs, and CLOs issuance skyrocketed to over $45 billion in 2021. Just so that the crowd understands, CLOs are commercial loan obligations, and they're basically where a lender takes all their loans and they securitize it, not as your loan is securitized, but it's a financing vehicle that everyone has used. Tell us about the CLO market issuance, what the investors are thinking, what is the cost of capital, and which will ultimately affect the clients. But more important is, going back to my first thing, is while you're issuing new CLOs, while you're doing new loans, you have to be getting calls from people saying, okay, I signed up this deal at when LIBOR was, or SOFR was X, it's now Y. My cost of capital has gone from 5% to 7.5% or 8%. So how are you managing all that? So again, I want to make this interactive, so who would like to start with that?
I'll start with the CLOs. So let me put some numbers on CLOs for the crowd, and I think, Ralph, you did a great job of describing what they are. So CLOs are a way in which a number of debt funds finance themselves. That's how we go out and get our money above our equity. And we did a CLO in January 13th, which is right around the time that Ralph was talking about when he was in the car driving. And it was a great time to do a CLO, and we priced our AAAs at 1.25% over SOFR, and our BBB minuses at 3.4% over SOFR, for a weighted average cost, including the other bonds, of 1.58 over SOFR. So fast forward to October, and ReadyCap went out and did a transaction. Great deal, no issues with the transaction. I would say comparable to ours, same size. Their AAAs went at 2.75%, so that's 120% wider. Their BBB minuses, if they had sold, were at 675, which is 100% wider. So their cost of funds went from my deal from 1.58% to 3.31%. And let's go back to this. The BBB minuses were not placed. So it was either not economic or they couldn't place it. In other words, the demand for subordinate CLO debt has evaporated during this time frame. So what you're looking at is a lending market that we are all out trying to work with you guys to put your loans out there. That's being backed by a CLO market that has profoundly changed. It's less liquid. The cost of financing has gone up. We get less leverage. It's still there, and the good thing is it's healthy. So it is, even though we had these problems, it's still active, and that's why we're still active. Now let's talk about, there's another point you brought which I thought was interesting, was warehousing, right? So the banks, right, the money center banks, they provide warehousing to us, and that warehousing can come in two forms. One, we could use it as a permanent place to hold a loan or finance a loan. Or the other thing is we can use it as a temporary place to hold loans before we do our CLOs. Peter does the same thing. Yeah. And what's interesting is that because the banks are constrained or have liquidity or whatever you want to call the reasons, they are more conservative. They are putting pressure on a number of us to make sure that we do use the lines more for CLO issuance. And because the CLO market is much more expensive, a number of competitors of ours have chosen not to go to the CLO market, so they've kept a significant amount of loans on these warehouse lines. That makes the banks more conservative, and it creates a pattern of which there is pressure even on the warehouse side. And so what we've seen is leverage come down on the warehouse side and pricing go up by 100 basis points, from 150 to 175 out to 275 in the current market. So these effects behind the scenes are having a profound effect on the cost of capital, the amount of leverage that we can put in place, the comfort level associated with our ability to take on large amounts of risk, because we're nervous about the carpet being pulled out from underneath us.
Yeah, if you looked at all the issuance in the summer issuance in the CLO market was basically the warehouse lenders forcing, really puking out all of the portfolios of loans that were originated at SOFR 300, 325 or whatnot. And obviously that didn't go so well. We got out a month after you guys did.
Good deal.
And from a 125, we went to a SOFR 165 on the AAAs. That's out, as you pointed out, to 275. That's a 6.5% AAA coupon right now. So that's historic all-time wides. What you're getting on AAA bonds, and that tells everyone that you should be buying AAAs and they should be tightening in. But it hasn't done so yet. It should next year, but right now there's just not a deep bid for that product.
We at NewPoint, so we actually started a bridge loan program, transitional multifamily, in the beginning of this year. Phenomenally successful, put approximately $1 billion in the program. Unfortunately, rode that sort of wave in terms of spreads widening, have yet to make it to the CLO market. But very much seeing that same phenomena in terms of warehouse lenders being very kind of eager to see things move along, and certainly the large money center banks, as Doug described, kind of being very reticent to provide additional liquidity. But a little to your point, Ralph, what we are seeing, though, is other banks, this is in the warehouse space, but just as a kind of representation of kind of where banks are, other banks having stepped up to offer liquidity. I think that process will continue, because when you back away from just where the public CLO markets are, the notion that you can lend at SOFR plus 275 or 300 against a 75% loan, against a 75% piece of real estate, is actually a pretty attractive risk-adjusted return. And this is not about, I think, fundamental risk concerns the banks have. It's all about capital and liquidity. And that will ease at some point. Is it the first quarter of next year, second quarter? Probably closer to the first quarter, at which point I think we're going to see a little bit more loosening and a little bit of the revival in terms of the CLO market and the public capital markets.
You know what I would say? I mean, this is all driven by the Fed. They're doing exactly this impacts exactly what the Fed wants, right? The reason why bond holders are not, as Peter indicated, AAAs are historically cheap on on AAAs. And the reason why this is happening is because in the money markets, you're seeing redemptions from money managers right now because people are pulling their money out of debt because they're nervous about rising interest rates. And so what it causes is like the BlackRocks of the world and the PIMCOs, they have to rebalance their portfolio. CLOs are historically liquid, so they're easy things to sell, so they sell out of those types of assets, and that's why AAAs aren't tightening in, and that will continue in this pattern until the Fed completes its cycle.
Well, thank you. So on to our next topic, the elephant in the room. Has anyone noticed that rates are up?
Yeah.
All right, guys, with a show of hands, how many people really have noticed that rates are up? So why don't you look at these charts? Because at the end of the day, I said I've gone through many cycles, but even I was surprised, and we talk about this internally and externally, is at the pace and the speed that rates moved it as quickly as they did. One of the biggest thoughts in everyone's buyer's mind is now, my cost of capital has gone up. I'm not even talking about existing loans that have changed if they were, and we'll spend some time talking about cap costs and talking about everything else. One guy came over to me yesterday and he said to me, I spent $350,000 on my cap to cap my loan. It is worth $3.5 million today. I'm actually going to put the deal, I put this property back on the market so I can capture that cost because I see exactly where my cap cost is going in 18 months, and we'll spend a little time talking about that because I think it's important. We started out the year, bank rates were at 3.5%. You know, we have some of the banks in the room, so I'm going to try to say this. Yes, Joe, I'm referring to you. Rates, there are some banks that are still at 5.5%, 6%. It's a challenging market for a bank. Banks are losing some deposits to treasuries because we're seeing a lot of that. And they're also managing a portfolio with maturities. So I think the banks have done a great job through COVID. The way they handled it was just unbelievable, and I think they continue to underwrite well. And I get to talk to a lot of people every day, and they ask me, you know, do you think there is a systemic issue in the bank's balance sheets? And I truly do believe there is not, because I think credit cultures on the agencies, even at all the debt funds, were pretty well balanced, and where the risk is really in the equity, and I'm sure that everyone here knows that. But we all started out with, you know, where LIBOR was a 325 spread. We knew what LIBOR was. You saw what I said, January 1st, it was 10 basis points. It's now, you know, 380, 420, it's all over the place at SOFR. So here's the most important question to the panel. What advice do you give a borrower regarding what they should do? And I said this to people all the time. If you sat in my office and my colleagues here that do it, and they really listened to me a whole day, they would say, this guy's schizophrenic. He changes his mind from the morning to the afternoon. Yes, Usher, you sit there, right? And I'm not. I'm just reacting to market conditions, borrowers, and lenders. And I think that's probably the most important thing that, as an advisor, I try to encourage my people. Don't just come out with a blanket statement. But we have some of the best people in the industry here. And how do you advise a client? How do you advise people? Do you borrow 10-year money, David, at a treasury this and you put it away? Do you take short term? I mean, I'm not asking you to predict interest rates because that's the last question for the panel. But at the end of the day, and by the way, I got the best prediction. A guy came over to me, he said, this is all going to change. It's like COVID. Everyone's nervous. I said, what does COVID have to do with the Feds raising rates? He goes, I don't know. Everyone was panicking by COVID. Everyone thought the world was coming to an end, and you see how great it came out. So if you're thinking that way, listen, you never know. Maybe the government will come out with a stimulus plan to help multifamily owners make their mortgage plan. You never know with politics what can happen, you know what I mean? So, but we'll stick to the question. So how do you, David, please start, and then we'll move this around.
Well, the answer to what's the right structure is whatever the client wants is the right financing structure.
The client don't know what they want.
And at which point, I will go on a limb and I'll say, I mean, you mentioned kind of 10-year fixed. So we're in a heightened period of volatility. The yield curve itself, right, where you have higher rates in the middle of the term structure and in the end, that's telling us something. That's telling us that we do think, you know, rates are somewhat elevated for a period of time. And it really does beg the question, I mean, so how is this all going to play out? Particularly knowing, and can come back to this later, that multifamily U.S. housing in general is actually a very strong spot. And so I'd actually say borrowing shorter term, whether it's 3 years, 5 or 7 years, is a better strategy, knowing that in fact you can reassess your borrowing a few years down the road and not lock in relatively high 10-year finance costs. It may be rates don't come down, of course, but certainly if they don't, that suggests we're in a high rent, high growth environment, be the opportunity to kind of re-lever up, which again, I'd say shorter term still makes more sense. And I would suggest even with cap costs where they are, even with the interest rate volatility, floating rate is actually probably a better option for that because it gives you the maximum optionality in terms of either being able to refinance into a lower fixed rate further out or being able to re-lever even if you're going to stay floating. So we'll see if that makes sense. I'll deny it if we're back here a year from now and that was not the right strategy.
No, but it makes sense because either way you're going to have negative leverage. There hasn't been any real positive leverage loans made that I've seen in quite a while. So you're going to be negative leverage across the board, which doesn't mean it's a bad deal or that 4.5 cap asset that you're buying isn't worth a 4.5 cap just because you're financing it at 6 or 6.5. So if you really look at it and say, okay, great, at 4.5, is it going to get, what are cap rates going to do? And how can I grow the income through, the plans that all you guys do? And, can that really offset, it's kind of a race. Where does that cross over? But yeah, I would say keep it short and, okay, great, it's costing your negative leverage 2% a year, 200 basis points a year. Okay, so that means you overpaid, if you want to look at it that way, by 4 or 5% before hopefully things right themselves and you get down to a normal interest rate environment. Not the end of the world.
Just to add to David, so a client calls me up on Thursday, he says, I have a $63 million loan maturing in February. I was hoping I would get 85 million. The bids are coming in around 69. Can you talk to your guys? And he says to me, I think the agencies are going to come out with a program to blend and extend. And I said, that's a great idea. So I called a guru in the agency business. And I said, David, what do you think of this program? He goes, no, that's called a workout. So I called him back and he said, that was quick. I said, yeah, I called the guy that wrote half the programs in the multifamily space, said it's a workout. He goes, okay, but if it's a blend and extend, do I not want that? I said, no, you don't understand. So it's just so fascinating to me how, the mindset has gone from, and the guy said, listen, I don't want to lock into a 10-year deal at 6%, so I just need 2 years because, it's like one of the, Yoni and I were on first I want to welcome my friends from the Community Bank. I hope everything went well on your approval call this morning, so thank God. All right, that's good to know. Forget about everything else in the room. If those loans are approved, we're happy. But anyway, great friends, great lenders, and just received approval on an acquisition of doubling the size of the bank, buying Flagstar Bank, so congratulations. But anyway, so just to keep on going, I'd love, Doug, why don't you answer that?
Yeah, it's interesting. I take a slightly different view. First of all, I think it's very difficult. Listen, I know it's impossible for anyone in this room to know where interest rates are going to be in the next 3 years. And so my advice, and I'm asked this question a lot by borrowers, is I say, I would go into the 3 to 5 year range right now of financing. I would, maturity is going to be your number one concern, extensions and maturity. And so if you can get yourself into a 5-year fixed rate loan, doesn't matter if you get it from a regional bank, maybe CMBS, it doesn't matter. I'm not going to talk our book, but, and you can get that at 6 or 6.5%, I think you jump all over that right now. Because in both scenarios, you basically win. One, obviously, if the Fed overcorrects, which is a possibility, and long-term rates come down, that's going to happen over the next 2 or 3 years, and then you'll have lower rates, you'll be able to refinance out, you'll be in fine shape. If inflation really kicks into gear, right, and there have been scenarios and predictions by some pundits that it's going to be, this could be way worse, and rates go up much, much higher. I mean, the long-term 10-year, if you look at the forward rate now, is sitting at 4.2 to 4.6 from 2 years out to 10 years out. So the market's telling you right now these rates are going to be in for a long time, or going to be high for a long period of time. That 5-year provides more protection, more chance for you to protect your asset. And also, if you're in multifamilies and you buy the right asset, you should be able to grow your NOI, which will help you solve your problem. So I mean, I would if you're in a loan that potentially is going to mature in the next 12 to 24 months, I'd be working proactively to look at how you could possibly get those extensions taken care of earlier.
And if I can only jump in to share that view entirely with Doug, would only talk about the agencies for a moment, where they tend to not be as competitive on 5-year, but they do offer 7 years with some open period, meaning you can prepay it at an earlier period of time, prepayable after 5 years. And would say that's not a bad kind of option, certainly in the agency world, for getting something that looks like 5-year financing with that type of optionality. I think you're going to see a revival of interest in that type of product.
Brian, would you like to add to that, or?
Not much. I certainly agree it makes sense from a short-term loan perspective, a short-term rate perspective. Our business is different. A lot of time, our stuff is transitional in nature. I mean, if there's cash flow in the assets, we're high-fiving. If there's cash flow that's significant, it's very much uncommon for us. What we're doing is providing, short-term 3 to 5 year type loans, and I certainly think, from a floating rate perspective, that's where you want to be. I think that there are things to do to keep in mind when you're thinking about it, whether it's new origination or recapping your transitional deals, which is, a lot of these loans, what is historically being done is you're setting the lender's setting your SOFR rate at the then existing SOFR as the floor, right? So you're in an elevated, obviously, SOFR period. And I think to Peter's comment, look, if you look at the 10-year now where the forward curve is, yes, you see it based, it's not going down for any short-term period of time. But if you do look at where the SOFR curve is it's expected to peak at somewhere in the low 5s, and then it's going to come down pretty significantly more to the mid 3s, right? So I think you just need to be mindful of understanding that you should play the potential for rates to come down by working with your lenders to make sure you can have some of that advantage when rates do come down. And so a lot of that is thinking through, your strategy and how you play it. But I think all those things come into play as how you can benefit.
Well, thank you. So, as I started my career as a broker in 1983, and I would go to see clients, and it was interesting. The father was 60 years old, the son was 35. They sat in the same room, and they would talk about, oh my God, interest rates in the late 70s were 17, 18, 19%, and in the 60s you got a 3% rate, you'll never see that again. They spoke about crime in New York City, they said you'll never see that again. So everything seems to, come all together. But in reality is, it's nice to tell that to people, but one of the things I tell clients, and I have a very dear friend here, Ellie Schroen, whose father is literally my mentor in real estate and in charity, and just how to live a life of balanced values. And he always taught me back in the early days, he said, Ralph, there's no bad real estate. There's bad partners, we all know about that, but there's bad timing. And always look at your whole portfolio as where do you stand? And many times when we look at scenarios, we'll say, okay, what else do I have maturing at that period of time? I don't want to have X amount of loans maturing at that time. And I think, over the years, like anything else, so, you say to yourself, that's a little bit outdated, but now you really see how it's happening. And I have this same client that told me about the $63 million. He said, my father was an old timer. He always talked about maturing loans, staggering them. And he said, thank God that when I look at my portfolio, I don't have that many coming due over the next 2-year period. So I encourage that. I know this is a younger crowd, so we're not as focused on just all the maturities. But I'm telling you, it's a real smart way to look at different maturity dates and where they are. And I think what David said is really an important point, that you can borrow 5 and 7 year money. 5-year money is not as, especially on the agency side, but on the bank side, the 5-year money is a sweet spot, and we've done a lot of that. But 7-year loans with some flexibility and prepay. So I think the real question is also for this panel is, what's really happening to values? I mean, I don't want to single out some people, but I've gotten calls, what's really happened to my value? Is my equity eroded? We've seen interest rates where they are. Where are cap rates going? What's that really doing to values? Is this we all agree that this is not a short-term thing. I've heard 6 months, 12 months, 18 months. But is this something that, values are going to change dramatically? So what happens when someone really shows up and his loan's maturing and, there was a good exit test, but even that's gotten blown through. So I know that, Brian, I'm sure at your company you're talking about rescue capital and coming back in and taking some of those positions. But why don't you share, this is just for the panel, where are values going to go in the next 12 to 24 months? Forget about making interest rate decisions, but in values decisions, and how are you advising clients?
They'll be up 11%. I'm just kidding. Look, no, obviously none of us know, but look, my view is I certainly, and Ralph will like this, the optimistic view is if you look at an asset class that is most in favor, you would do multifamily one and maybe industrial second, right? This is not a structural change. People will continue to live. Now, as we all know, real estate is local, so that'll depend, supply, demand, fundamentals, et cetera. But at the end of the day, depending on what data you look at, the U.S. real estate multifamily market is undersupplied by somewhere between 2 and 6 million units. There is no question, right, that there is a demand for that. So for me, it's just a short-term issue, right? And it's figuring out a way for you to bridge that short term. There's 400+ billion of institutional capital waiting on the sidelines to be helpful, right? There is massive liquidity that's going to come into this market, and multifamily is the first one that's going to benefit from that.
But there's also not enough data points yet. I mean, we've seen, we've all seen probably a couple hundred packages over the last, say, 60, 90 days, and everyone thinks that, and you have knuckleheads on your investment committee saying like, oh, everything in the United States is a 6 cap on a multi, and that's clearly not the case. But if you really look at some of the public company valuations like Avalon Bay is trading at a 6%, their market cap is a 6% cap rate. And I don't think, and they calculate things differently than we all do in this room. But I think what you really need, and again, as I was saying, so you're still seeing, people are still buying things at 4.5 cap rates if they believe in their business plan and whatnot. They're not getting the 75, 80% leverage, but they're still getting 60% leverage, 65% leverage, at the SOFR, mid-3 range.
And there is, sorry to interrupt, go ahead.
Yeah. No, keep going.
And there is capital to fill that gap, right? It is more expensive without question, but the reality is if it's short-term capital, the difference, and ultimately if you're an owner looking for liquidity to sell an asset at an elevated price because people want to be predatory, just makes no sense because you can put in a short-term capital for 2 years, 3 years, a year and a half, and ultimately cap rates will settle back down. Again, there's just so much liquidity. There's turmoil, of course, geopolitically across the world. I think multifamily is going to be that asset class to benefit. So when we're thinking, just to put a fine point on, when we're thinking about underwriting deals, we haven't adjusted our exit cap rates to any significant portion, and in large part it depends on the market. And of course, inherent in any of those cap rates is the projections on growth. And with a demand far exceeding supply, again, everything's local, the expectation is you're going to have maybe a brief cessation in rent growth, and you're going to see rent growth. It's just a supply-demand analysis, and that's going to very much impact people's view as to when you want to, if there's a cap rate increase. So personally, and I don't speak certainly for all related, I'm not particularly of the opinion that you're going to see cap rates elevated any more than, to put a number out there, 50 basis points max.
That's optimistic. I'd love David to comment on this because he's
I'm probably a little bit further up in terms of how much I think they move. I think you're probably more in the 100 to 150 up from where the lows were. And would only point out, I mean, at the lows, I think people were both basically, if you thought you had a 3.5 cap rate, what you were also really saying is, but I've got a forward on a 4.5% cap rate because I know where I would have such strong rent growth that as soon as we kind of get marked all the leases to market, I'm at that level. And I don't know that you can as reliably count on that. In addition to that was during a period where we had 1.5% 10 years. If we think we may have, and who knows, 3.5% 10 year, a little bit higher, we think rent growth will continue to be strong, and absolutely agree with Brian in terms of the fundamentals. We are looking at strong multifamily growth for really as far as we can see given the housing shortage. but still it's probably not going to be 20% increases in terms of rents, probably higher single digits. Rule of thumb, we always just use it, Freddie Mac, inflation plus 1% to 2% is probably a reasonable kind of estimate. Not all markets, every market will be different. But I think when you kind of put that together, probably looking at a little bit higher cap rate in terms of where we settle in, though recognizing that it's probably tighter than it was sort of historically. That I think the offset to all of that that's a big positive is there continue to be strong interest in multifamily across U.S. multifamily across the globe, greater recognition of it as a liquid institutional asset class and something that's got a high degree of resiliency in terms of economic stress. And so I think we'll continue to see that once kind of the dust settles through this liquidity crisis, that we will see those capital flows resume, and that'll keep a ceiling on where cap rates can go. But I'd probably just put them, if you thought the low, wherever you put the low in any given market, I think you're up 1 to 150 basis points in terms of where we settle out.
I would say it's interesting. I mean, what everyone's saying here, if you summarize it, there's a struggle between public valuations and private valuations, right? The public markets are clearly pointing towards that 6% cap rate number. But properties on an individual's basis are trading, let's call it in the high 4s, low 5s right now. And that explains your debt gap, right? Because the debt that we are all offering generally is tied to public markets, whether it's public interest rates or whether it's public capital markets or structured finance markets. And that's why your leverage has come down into the low 60s, because we are effectively levering on a 6% cap rate and you guys are buying at a 5% cap rate. And so unfortunately, no one knows how this concludes, right? Hopefully, long-term interest rates come down and that'll mean senior debt will increase and things will continue to trade at a 5. Or the vice versa,
but I think
is right.
I think we're talking very general. I met, I don't know if this client is in the room, and we've been struggling to get this client supplemental financing. His rate on the senior is 3.2, and the lender is saying we want to have an exit test on the whole debt, so it's not working for the $10 million he thought he was going to get. So, being a good broker, I knew the facts, and I said to him, we're still working on it. And he said, don't worry, I signed an LOI to sell the building. I believe it was a 4.5 cap. And here's what's interesting. He said to me, it's a new client for you. Would you think that the existing lender would allow an assumption? Don't worry, Joe, it's not you and it's not you, so we're not asking you to allow an assumption of 3.2 interest rate. And I looked at that and I said, okay, so here's phenomenal. You can't get the $10 million supplemental that you thought you would get. This was a lease-up play during COVID. But you're selling it at a number, at a cap rate that really demonstrates, values from 6 months ago, and you're not even asking, it's not tied to that. And he told me it's an institutional client that owns multifamily in that market. So to me, that was extremely encouraging, and I can tell you about multiple deals that are trading at pretty aggressive cap rates because it's tied to assumptions of existing debt, especially if it's agency debt and some of the other ones. But David, you always talk about, and Peter, you touched on that, or Brian, you touched on that, the shortage of housing in America. And we also at NewPoint do have the single family business that you've launched. So I'd love you just to share with us, and it's a little bit off script, just your view of shortage of housing, because I think that's something that people should understand, because it's really, really driving rent growth, even if...
Sure. And Brian alluded to before, I mean, you have different analyses coming up with different numbers, but we have a shortage of millions of houses in the country, and obviously more so in some markets. I mean, part of the issue is in the fastest growing markets, it's most acute, and that's what's driving the high rent growth. And we're just we're not seeing enough building. It's much more challenging in many of those markets to build not just multifamily, but even additional single-family homes that are affordable, kind of the median household. And that just creates an additional tailwind to rental growth. So we've got growth in those markets. We didn't have enough housing to begin with, and we're not able to build more. And then you've got higher rates, actually further constraining home building, because most home builders can't finance to build additional houses. And so that actually creates a nice kind of profile in terms of where you think rent growth might go going forward, and where you might have optimism, again, about multifamily for the long run, and even for the single-family rental space, which I think is going to increasingly become a major part of the rental housing landscape and a major part of investors' portfolios. Folks who are comfortable in multifamily, I think, may naturally pivot into either build for rent or even scattered site single-family rental as an appropriate alternative.
Yeah, but you're really bumping into what we're seeing now is affordability issues, where, you'd go and you'd look at, okay, great, and everyone's plan was to spend 10, 12 grand on a unit, renovate it, and pop the rent by 200, 250. And we're just in Arlington, Texas, near the AT&T Stadium, looking at a bunch of assets there. The premium for like a tricked out, beautiful renovated apartment, undermount sinks, quartz, the whole 9 yards, versus the unrenovated was basically $100. And that wasn't just one property, that was about 5 properties that went to. And I was very surprised that wasn't as wide, because clearly better, but they were basically saying that people just can't afford it. Occupancies were still 94%, and they were still getting on lease renewals 8%, and new leases were 15 or 20, I think. But that was interesting.
Great. So I'm going to move this along because we have 10 minutes left. And the next question, as you see in the chart, is lender underwriting began to tighten 12 months ago. The average apartment building loan fell to approximately 65%. It was 65, it's now to 60. Debt yields jumped to 7.5 to 8.5 in average multifamily. Question for the panel. How have you changed your underwriting? And I know we've covered this throughout this discussion, so if it's repetitive, and I do want to see if we can get 1 or 2 or 3 questions into this. How have you changed your underwriting, if at all, over the course of the year? We heard you say that, Peter, you've not really changed your exit. I think you were the one that said it, or Brian said that. And also, what do you expect for 2023? I mean, we've seen on the agency side some flexibility going to 35-year amortization. I think it's really important that the crowd understands that, and I'm going to say this, I'm trying to be politically correct. Lenders want to make loans. They want to make good loans. They don't get paid enough money to take equity risk, and they do have regulators. You have investors. I say this all the time. You have investors. You have auditors. You have to answer questions. Every lender has, we heard this from Peter saying the knuckleheads in his committee. I hope we won't repeat that.
That in a nice way.
But at the end of the day, everyone has directors. Everyone has. One of my famous stories, when I was a young broker and I came to a bank and said to the banker, I said, I'm trying to pitch my loans. And he said, what are you doing for the next hour? I can talk about it now because it's 30 years ago. And he said to me, I want you to come with me. And he took me to a loan committee. He said, you sit in the corner and you never tell anyone you were here. Of course, I went back to my office. I told all my partners how great it was to be in there. And I saw this loan office. I saw the head of this real estate group that was one of the most profound lenders sit there and have to answer to 7 directors questions that were being thrown at that person. So I want the audience to understand, and us at Meridian, we like you all to think that we're magicians and we can do everything, but the market has put lenders in a tricky position where they have to answer to their boards, to the regulators, and to everyone else. So underwriting is not just because they wake up, and I say this all the time, they're not paid enough money to take the risk. And David, you created the whole case series at Freddie Mac and created this whole thesis, how loan to values. I've always been amazed. One of the first times I heard you speak was how you said the risk between a 63% loan to value and a 75, and then from 72 to 80, whatever the numbers were, I'm just probably brokering them a little bit in my favor. But at the end of the day, it really demonstrated, risk profile and getting paid for that. But let's just talk about, underwriting in a very quick way, and also, how do you stay in business? Banks and lenders only make money by making loans, making good loans. They want to continue to do this. So have you changed your underwriting, and have you seen all this thing?
I'll take a shot real quick. I mean, listen, we talked about some of the basic numbers, right? We're underwriting to more like a 7.5 exit stabilized debt yield now in this environment, where that may have been 6.5 or 6.75 before. We're targeting stabilized LTVs now in the 60s where they were in the 70s before. But I think there's two things that are very important that are probably softer things. One, we're spending more time looking at the sponsor and understanding how hands-on they are, how much capital they have devoted to the transaction, and their track record. If you've bought multis and you've been in there in the trenches and getting those rental increases and providing good service and the cash flow's been increasing, that's very comforting going forward to us. It's something that we will account for. The second thing Peter highlighted, which I think it needs to be re-highlighted, is affordability. Just because you can put 10,000 or 15,000 a unit, it doesn't mean that they have the demand at $500 more of rent per month in that area. And so we're looking very closely at the average incomes in those markets and seeing, is it affordable? Is it reasonable to expect this type of clientele to be able to pay those rents?
Yeah, we're looking at the same way. We're doing a 7.5 debt yield for the most part. We haven't yet to do an 8 because it's just not in the market on that stabilized debt yield. On that as well, and just trying to figure out. When talked about sponsorship and whatnot, it's interesting. And we go back and we have attention. We do our largest deal we did last year was 245, or this year was 245 million. Our smallest was probably 25, except for a couple of add-ons. But what's interesting though is really look and say, okay, the best sponsorship must be the guys who are borrowing the most. And yes, that might be the best sponsorship if you really want to say a known entity. But if you really look through sort of the execution, most of the guys who really executed on their business plans weren't those guys. The guys who executed on their business plans were guys who are actually in the market, know what's going on. And it's nice when we, do a guy's buying 5 properties or 4 properties in a market, and you can put 4 red dots and they own those properties. That makes me feel, and they've executed a business plan in the past, that makes me feel a hell of a lot better than lending money to an institutional sponsor who's, candidly, those guys are all, and private equity guys are doing, they're playing roulette now. They're not playing blackjack.
I think your point's really important. It's when you go to the property tour and the owner shows up and the management team knows them, they know exactly the business plan, they're in there making sure they're solving problems, they can explain everything that's going wrong and what's going right, and then you see the numbers and the numbers are good. That's very comforting. I'm super optimistic to do those loans next year, because that's going to differentiate, that'll protect us as lenders against bad scenarios.
Just only one minor, I agree with everything these guys said as far as the focus on the sponsor, on their commitment, on the business plan making sense. Would just also add structure, just makes that much more, is that much more important right now. Structure regarding how you're dealing with interest rate caps, not interest rate caps, interest rate reserves, how you're dealing with extension tests, how you're dealing with other elements of the structure. I'm thinking primarily of bridge loans in this context, that certainly where there is likely to be some of the stresses where everyone didn't anticipate kind of what the implications were going to be of various extension tests, maturities, cap requirements. And so I think putting a little bit more thought into how that's going to work and how that matches the business plan in terms of timing. And so we're kind of investing more on that front. The only thing in terms of the agencies, since you're asking about underwriting, as folks may know, the agencies primarily underwrite to debt coverage, which does have this automatic effect of effectively lowering coverage as rates go down. And that's going to be interesting as that plays out through 2023. As you mentioned, Ralph, both agencies pretty good about leaning in, particularly if there's any affordability on 35-year AM and or 1-2 debt coverages. And it'll be, I think, interesting to see how that continues through 2023.
Well, anyway, we're down to 2.5 minutes left, and if anyone has a really interesting question, but I just want to end by giving a very general, my next question, I think we covered in many different, scenarios, is how you're dealing with loans that are maturing. So in the interest of time, I will just give some advice because I deal with this half my day. Get ahead of it. You're all smart, you all understand your business, you all know where interest rates are, what your cap cost is. I was impressed. I met a client yesterday. He said he bought a building, had a very significant fire within a couple of days. And I asked him how he's doing. He said, I am so impressed with the lender. They come out, they inspect. And we've really developed a relationship with them where They're appreciative of all the issues that we've gone through, and we're releasing, and we're doing well. Be very upfront and transparent with your lenders. If there's good news, share good news. If there's bad news, share bad news. No one's looking to wake up one day and say, oh my God, why didn't you tell me this? Everything can be managed, everything can be dealt with if you figure it out early. I always talk about some of the situations I've had throughout my career, and most of them, the ones that ended up in issues and troubles where we weren't transparent, we tried to dance around the issues, and ultimately timing caught up with us. I tell my brokers all the time, and I tell you as clients, potential clients, or just colleagues in the real estate business, get ahead of it. You can manage through anything. There's nothing that is not manageable in the real estate business. Hard assets, it's not a stock, it doesn't get marked to market every day. Investors understand what's going on in the market. Don't be embarrassed to tell your investors, we're not making distributions, because at the end of the day, we need to keep our loan current and we need to keep our building well maintained. You never want a bank to go there and find 11 vacant apartments and you're taking parts from this oven to fix that oven because you don't want to buy a new one. And guys, I've seen that, okay? And I'm telling you, that is where the mistakes happen. So as someone that's doing this for many years, and thank God has built a great company with a great reputation, I'm just sharing some of the advice that I see, and I hope I'm echoing what every single lender would say in that. With 3 seconds left, I don't think we're going to get to any questions. I just want to say, I want to thank the eCore guys. You've done an amazing job. Now, you need to understand, my biggest challenge is I try to convince them not to let any of my competitors in. But at the end of the day, we all work together. We're in a great industry. I send a message to the firm every single Friday, and the one I sent last week was that there are billions of gallons of water in the ocean, and they cannot sink a boat. The only time a boat can get sunk is when there's a hole and you let the water in. Same thing with negativity. Don't let it infect your business. It's a reality. Interest rates are up. Volume's going to be down, but there is a long horizon in real estate. And just be conscious of your issues, work through them, stick with them, and I think you will all have continued success. I just want to encourage you, if Meridian is your firm, always reach out to your brokers for any questions. I'm always available. Some of my partners are. If you're not, try us once. Try it. You'll like it. We have a great dinner planned for you tonight. We have a great speaker, Kevin O'Leary. They came in to tell me he's Mr. Wonderful, and I said I thought I was Mr. Wonderful, but at the end of the day, we really look forward to hosting you this evening. I thank everyone for coming to this conference. I thank this unbelievable panelists, every single one, and please feel free to come over. Thank you very much.